Okay, guys, the votes are in. I asked you what you'd like me to review, and the answer by majority is Airtel Africa. I want to add some value to your day, to your investing journey, by summarising my findings of my research into Airtel Africa. Is it a stock to buy? Let's find out. I've even dusted off my old calculator, and we can try and estimate the projected return. So in under 10 minutes, let's find out if Airtel Africa could be the star of your portfolio. So without further ado, let's get started. Okay, guys, so the quality of the company, first of all, the return on capital. That return on capital was a measly 2.6% when they first came public. That's increased beautifully, a nice upwards trend to above 20%, which is the sign of a good company and good management team. Do note, by the way, all the figures that you'll see here are in dollars, even though the company is UK listed. If we look at gross margin next to all, gross margin ticking up to above 60%. Again, a sign they've got some pricing power, and they can withstand some inflationary shocks. So it's a good value and its trajectory is upwards. And then we'll have a look at their operating margin. And again, that's gone from a very low figure as a newer company to the market, and that's gone up. It's now over 30%, which again is a very, very strong operating margin. And their free cash flow was negative, and then that's gone up to around about $1.4 billion. So what's that? 1.1, 1.2 billion pounds. Bear in mind the market cap is what, £4 billion? The free cash flow margin is extremely high. So the early signs about the quality of this company are really good. Now, I do have some concerns, and join me on the journey here with this. First of all, their current ratio, that is below 1. You can see here that is consistently below 1. If you scroll down to their debt to equity, that is over 100%. It's been worse, so the trajectory is downwards, but it's still relatively high. And their interest cover is around about 5 times. Not a great figure, below what I'd think for a quality company, but it started off as 0.5 and it's improved. So although those metrics aren't sort of amazing, they are getting better and they're okay. Now, if we look at some of the other factors about what the company does, it does feel like it's a growing industry for sure, although there aren't many companies in this industry that are massively profitable, no debt. And the other thing I found was that the ownership situation is a bit strange. But before we get on to that, let's just have a look at the dividend. Because if you look at their trailing dividend yield, you can see the dividend yield at the moment is about 3.8%. Now, for a company that's relatively newly incorporated, that is growing quite quickly, that is unusual to have a dividend of this nature, particularly with a high return on capital, because you think the return would be better reinvesting back into the business. Paying back to their income statement, the affordability dividend is actually good. It's only about 30% payout ratio. Although the dividend per share is, what, 5 pence, relatively newly established, it is an affordable dividend. But for me, when they've got that debt, they're good at growing the business, why would you pay them out dividends? That doesn't make sense to me. Normally, for a company that's growing quickly, and you can see that they are growing quickly, going from 2.8 billion up to 5 billion in revenue, doesn't feel like quite the right thing to do. And I did a bit more digging and I found out why. It's the ownership of the company. Flipping over to Simply Wall Street, now have a look at the ownership, and then we scroll down a bit here. The ownership breakdown is actually over 50% by an overseas holding company. So actually less than half the company is publicly traded. I imagine that the overseas parent company wants some sort of return from the business, and therefore they're being paid that dividend. So if the dividend's being paid out, see, them as the largest shareholder is going to have a massive benefit of that. And you can see it look like there are a couple of other related companies with similar names there as well. So actually, it looks like probably maybe 40, maybe even less than 40% of the market cap is actually publicly traded, according to this information. That explains the dividend scenario. Now, there is future growth projected, and we're looking at around about 15 to 17%, according to Simply Wall Street's analysts. Flip over to Yahoo Finance, they're saying 17%. So let's be conservative and go with that 15%. That's still a very good rate of growth per annum. It's not all plain sailing. If you go back to their income statement again and look at these shares outstanding, there have been some significant increases in the dilution of shareholders or shares outstanding, up 70% in this financial year and 80% there. The number of shares outstanding was, you can see there it's showing as over 1,000. It's probably 1,000. So what's that? 1,000,000. That's increased dramatically up to several multiples of that. Now, it hasn't really happened in the last couple of years, so it's tailed off. As a shareholder, yes, you've got this growth. There's this dividend to be paid. You've got this debt. Now, they probably don't want to load more debt onto the company, which is why they've been diluting the shareholders. You could argue that's a good way to do it, but equally, it does dilute the shareholders. Pros and cons of it, but be aware of it. Now, for a company that's growing at 15%, their free cash flow ratio is excellent. They're currently trading, not that I pay too much attention to this, their P ratio of 8. So it's not an expensively rated company in the marketplace at the moment. So I can certainly see why some people might be saying, look at this, it might be interesting to buy. I've run some numbers, and the potential 5-year annualized return could be anywhere from 27%, and I've got that potentially even up to just over 50% per year. So this is quite a wide range of returns, depending on how you calculate it and what you think is going to happen in terms of issuance of shares and so on. But certainly what's clear is that the company produces a lot of free cash flow in relation to their market cap, and growth is projected. Therefore, there is an investment case there potentially. The other reason I thought around the cash flow is quite interesting is they do actually make a lot of cash from operations, but there's a lot of capex expenditure. You can understand why, given the industry they're operating, but it is worth noting that if those requirements increase, then that will impact their free cash flow, which is probably what's holding the company's market rating back a ton. Now, overall, here we've got a business that is going in the right direction. Their metrics are improving, they're all going in the right direction. However, there is that kind of question mark around the interest cover, the debt to equity, and also the current ratio. So it didn't feel like a buy to me, but then I looked at my portfolio. Have a look at BT Group that's in my portfolio over on ShareSite, and you can see that's been in my portfolio for around about 3 years, and it has returned 13% per annum. However, the FTSE 100, albeit in a short time frame, has actually returned more than that. It's worth £500 in my portfolio, so that's just over 1%, 1.25%. Not a huge holding, but it's a similar industry, although BT, of course, is a more mature company which has its entrenched positions of the BT Sport, EE, and their kind of network on the ground in the UK. I thought, let's just compare the companies to actually see, is BT actually better than Airtel Africa, compare their metrics, and that will give us a good idea of where Airtel Africa actually is. By the way, if you do like this site, which I do, it gives you your return per annum on a compound basis, which most sites don't do. Your brokerage probably won't do that. It gives you analysis on average purchase price and all your kind of adjustments. If you like the site, ShareSite, there is a link below to get a discount if you're interested in signing up. I found it useful helping to manage my portfolio across different brokers, so I'd welcome you to check that out if you so wish. But let's go back to BT and the TIKR terminal. Now, BT is a really interesting one because if we look at the financials, their gross margins are in the 40% range. Their revenue is pretty flat for a long period of time. Operating margins there are between 10 and 20%. It's probably an average of about 15. Airtel Africa already looks more attractive. There's not much going on the way of share issuance or buybacks. In fact, the number of shares outstanding has probably gone up over the last 10 years. Dividend has been all over the place, not reliable. Payout ratios all over the place. So again, I was thinking here, going, is Airtel Africa actually a better investment potentially than BT? Yeah, they do make free cash flow BT, but their free cash flow has been going down, and the free cash flow margin is single digits for several years. And then most importantly, their return on capital BT, amazingly, was 30% or so. That's gone down to 7-8%. You can see here on the screen. Gross profit's been going down. Current ratio is a little bit better than Airtel Africa, but not amazing. Debt to equity is worse, 150%. Interest cover's worse, 4 times. And the trajectory is down. So suddenly I'm thinking, actually, Airtel Africa, though a less mature company, that is the risk, actually looks more attractive, at least financially, in terms of the numbers on paper. BT does. Debt position looks better. The growth potential is certainly better. The margins are better. So the argument for my portfolio is, do I flip out BT for Airtel Africa? And that's probably an improvement. So that's the sort of thing I'd urge you to consider for your portfolio. Is it worth swapping out a company that's worse than this for Airtel Africa? Or indeed, do I just sell BT and have neither of them? Still a little bit worried about Airtel Africa's debt metrics that we talked about, although they are improving. So Airtel Africa is one of the most interesting companies on the UK stock exchange. There is actually one that potentially even more interesting. Check out this video over here, right over here. This video is a really interesting UK company that you can't afford to miss. It could help your portfolio. See you there.
Get to the chopper!